All right, let's talk about 2026. The market's being pulled in what feels like three different directions at once. You've got central banks ending the era of easy money, you've got this powerful economic rebound called reflation, and then there's the absolutely unstoppable race for AI dominance. So, what does all this mean for your investments? Let's dive in and break it down.
So, here's how we're going to tackle this. First, we'll get our heads around the big macro picture, what we're calling the reflation story. Then, we'll zoom in on the AI engine that's driving so much of this. From there, we'll hunt for opportunities in emerging markets, and then ground it all by looking at three specific companies that fit right into this whole puzzle. And finally, we'll wrap it all up with the key takeaways you need to know.
Okay, first up, according to the analysts over at LGT Wealth Management, if there is one single word you need to know to understand 2026, it's this one, reflation. Let's explore exactly why that is.
So, what on earth is reflation? Well, to put it simply, it's what happens when both economic growth and inflation start heating up at the same time. It's a sign of recovery. And the big takeaway here is that LGBT believes this is no longer just some possibility. It's become the central story for 2026. This isn't just theory anymore. It's the environment we need to be ready to navigate.
And what's the fuel for this recovery? It really comes down to one thing: credit. As central banks around the world continue to cut interest rates, borrowing gets cheaper. That's expected to really kickstart spending, especially in areas like housing and consumer goods, with things really starting to pick up steam by the middle of 2026.
You know, this slide really captures what's shaping up to be a tale of two halves for 2026. The first half, it looks pretty supportive for stocks, kind of riding that wave of recovery. But the whole story pivots right around mid-year, when those rate cuts are expected to stop. And that's when the second half gets a lot trickier, because markets will start to worry about the one thing that always ends a party: the withdrawal of easy money.
Okay, so let's move on to the primary force that's really driving this whole reflationary outlook, this absolutely unprecedented investment boom happening in artificial intelligence. But is it a truly sustainable engine for growth, or is it something else entirely? Now, just look at this chart. What's so wild here is the sheer scale of the investment we're talking about. This shows the capital expenditure, the CapEx, from the big tech giants, the so-called hyperscalers. I mean, look at that trajectory. It's an almost vertical climb in spending on data centers, on chips, on all the infrastructure AI needs. This spending spree is so massive, it's actually contributing as much to U.S. economic growth as the entire U.S. consumer. Think about that for a second.
But whenever you see a chart that goes straight up like that, you have to ask the critical question: is this a genuine revolution, or is this a massive bubble in the making? The great financial historian Charles Kindleberger had a pretty simple rule for this. He said it doesn't matter how a speculative mania starts, it always ends the same way: when the tap of easy money, that liquidity, gets turned off. And as we just saw, that is exactly the risk that's looming in the second half of 2026.
But hold on, there's another layer here. This isn't just about corporate profits. The race for AI dominance has become a primary battleground in the strategic rivalry between the US and China. Both governments are pouring support into their national champions, treating this with what some are calling a Manhattan Project-esque urgency. This geopolitical factor could act as a really powerful fuel, keeping this investment cycle going for much longer than purely rational economics might suggest.
Okay, so against this backdrop of AI-fueled reflation, where is the growth? Well, the analysis is pointing to one key area in particular: emerging markets. The whole story really starts right here, with this one number, 4.2%. That's the IMF's growth forecast for emerging economies. It's a number that immediately makes you sit up and pay attention. And this chart really puts that number into perspective. You've got 4.2% growth for emerging economies compared to just 1.6% for advanced economies. That's not just a small difference. That is a massive performance gap. It's a really clear signal of where the economic momentum is shifting on a global scale. So you might be wondering, what's actually causing this? Well, it boils down to two really powerful engines. On one side, you have financial services taking off as easier monetary policy lets banks finally open up the lending taps. And on the other side, you've got manufacturing just booming as companies continue to move their supply chains to new hubs like India, Vietnam, and Indonesia. All right, let's make this all real. We're going to shift gears now from these big macro ideas and look at three specific companies that seem perfectly positioned to capitalize on these exact trends we've been talking about. First up, we've got ICICI Bank in India. Now, this is a direct play on that financial services growth in emerging markets that we just saw. As India's economy continues to expand, so does the demand for banking, and especially for digital banking.
Now, when you look at the numbers, you see this really strong double-digit growth, which is great. But here's the key insight. Look at its forward PE ratio. That's a measure of its stock price compared to its earnings. It's significantly lower than the S&P 500 average. So in simple terms, you're getting really robust growth at what looks like a much more reasonable price.
And its whole strategy is laser-focused on digital. By constantly improving its services from start to finish and really driving the adoption of its mobile app, ICICI is just capturing huge market share in one of the world's fastest-growing digital economies.
Okay, let's move to our second company. This one sits at the absolute epicenter of the AI boom, Taiwan Semiconductor, or as you probably know it, TSMC. They are quite literally the essential manufacturer for the entire AI revolution.
I mean, just look at these numbers. The insatiable demand for AI chips is projected to drive staggering growth for TSMC. We're talking over 20% on both revenue and earnings. But here's the kicker. Even with that incredible growth, it's still trading at a valuation that's below its sector average.
So what's the crucial point here? It's their dominance. TSMC is the undisputed leader in manufacturing the most advanced chips on the planet. When an AI leader like NVIDIA needs someone to build their powerful new GPUs, they turn to TSMC. They are, quite simply, indispensable to the entire AI hardware ecosystem. And for our final example, let's head down to Latin America with Mercado Libre. This company is an absolute powerhouse that gives you exposure to two of the biggest growth stories in the entire region, e-commerce and digital finance. Okay, get ready for this. These numbers are just incredible. Projected earnings growth of over 50%. That's just wild. But what's really interesting here is its price-to-sales ratio, which is almost half that of the S&P 500. This could suggest that the market hasn't fully priced in just how explosive its growth potential really is. Mercado Libre's real strength comes from this dual dominance. It's like a 1-2 punch. It has already built the infrastructure and, maybe even more importantly, the trust to be the leader in both online retail and fintech. As more and more of Latin America comes online, its potential market is expanding faster than almost any of its global peers. Okay, so we've covered the macro environment, we've looked at the AI driver, and we've dug into some specific examples. Let's zoom back out and boil this all down into a few key takeaways for how to think about 2026. So what does this all mean for your portfolio? It really comes down to three key principles. First, buckle up. A smooth ride is pretty unlikely, so be prepared for volatility. Second, this probably isn't a market for just passive set-it-and-forget-it investing. Active management is likely going to be critical to navigate these big shifts. And finally, with reflation in the air, protecting against inflation by having some exposure to real assets, like infrastructure, could be crucial. And that leaves us with the central question for 2026, doesn't it? We are in a race for returns, and it's being fueled by an absolutely undeniable boom in AI. But is this the foundation of lasting productivity and real value? Or are we just watching another classic financial bubble inflate, waiting for that inevitable moment when the liquidity gets pulled away? That is the tension that is going to define the year ahead.